Hi everyone, this is a little mini lecture on chapter 2 of Understanding Business Ethics, and chapter 2 looks at some contemporary or modern day issues that we see in business ethics. So let's go ahead and get started. So chapter 2 starts by talking about the history of business ethics. And we have been dealing with ethics since the beginning of time. It has been um, in discussions by Aristotle, Socrates, and Plato. So, as long as we have been bartering and trading, or there's been commerce, there have been ethical issues about how we conduct business. So, some of the things that in the most recent years we've seen in the 60s, there was a lot of social unrest, there were a lot of environmental and drug. There are a lot of issues about the environment, drug use amongst people. There was a new birth of corporate responsibility. All of these things played into how businesses did or how organizations did business and what the ethical standards were. In 1970s, the economy suffered a recession, meaning we had a downturn in the economy. There were a lot more human rights issues, and then again, environmental issues were still a major focal point of corporations. So if environmental issues are something that people are focusing on, then that's going to be something that's going to be considered when we're looking at ethical decision making. However, in the 70s, companies began to cover up their wrongdoings rather than dealing with issues head on, which would lead to unethical behavior. In the 80s, we had a lot of financial fraud. Loyalty to employers decreased. People didn't stay with employers as long. Um, the Ethics Resource Center helped for the first business ethics office at General Dynamics in 1985. So that's really when we saw this being incorporated into businesses, um, especially in the United States. In the 90s, we saw a lot more global opportunities, which leads to a whole different set of business ethics concerns because what's ethical in one country or nation or even sovereign nation is different. It might not even might be, it is different than what is ethical, especially in terms of business and other areas. We saw unsafe work practices, child labor issues. We saw sweatshops being an issue. And we saw a lot more financial mismanagement or people not doing their accounting correctly. Some people call that creative accounting. Think of Enron. If you aren't aware of Enron, I encourage you to Google it because it was one of the huge cases that really spurred looking at global ethics or business ethics. And this continued into the 2000s, this financial mismanagement. We saw a lot more issues with intellectual property theft. I don't know if any of you grew up in the early 2000s, but if you remember Napster, that was the file sharing software, which ultimately was considered illegal. Um, but I don't know about you, but I remember my friends would go on to Napster and they'd get all these songs for free and they'd download them onto disc. And there were a lot of people who got in a lot of trouble for that. In 2002, we had the Sarbanes-Oxley Act, which helped us with some accounting standards. Specifically, the Sarbanes-Oxley Act is a U.S. federal law that mandates certain practices in financial record keeping and reporting for corporations, and this helps with that issue of creative accounting or accounting in ways that are unethical. So when we look at business ethics, integrity plays a large role. And integrity is just an adherence to a code of especially moral or altruistic values. Um, so integrity is based on an employee's continuous efforts to balance their own personal values with the requirements to perform their jobs effectively and efficiently throughout their careers. And so I'm sure you've heard this concept of the golden rule. And the golden rule just really says that there should be reciprocity between the individual and others, or I should do unto you as I would like others to do unto me. It's really funny that they use this. When I was in high school and college, I worked for a retailer. I worked for JCPenney. I'm sure you all know them. And they actually, in your training and in everything they did, they talked about the golden rule and really trying to create this sense of integrity within the company and of doing what is right. So they've been doing that since, the 90s when I started working there. So I really like this part. It's called integrity heuristics. And basically it says when you're making a decision, and you can do this in your personal life or in your private life, but you should ask yourselves these questions to determine whether they're ethical or not. So the publicity test asks whether an individual would be comfortable if his or her actions were publicized in a newspaper or television. So let's say you're faced with a dilemma at work and you're trying to decide if it's the right decision. You'll say, okay, would I be okay if this was in the paper? The trusted friend test. Would I be comfortable if I told this to my best friend or a close family member? The reciprocity test, or the Golden Rule test, says, if I treat somebody like this, would I be okay if they treated me in the same manner? The universality test asks whether the individual, or if you would consider it acceptable behavior if somebody else did the same action. And the obituary test asks you to look back on your previous actions during your career and ask if you're comfortable with the evaluation. So I really like these because I think, so often when we're making a decision, we're trying to decide if it's the right decision. And I think these help us to make a decision that we are comfortable and that we feel aligns with our morals and our ethical standards. So people who have high integrity have humility. They're looking at, they're not trying to be, humility is not having too much ego, I think is a good way to look at it. They maintain concern for the greater good of people. They're truthful. They fulfill their commitments. If they say they're going to do something, they do it. They try to be fair. They take responsibility for their actions. And I think with responsibility comes accountability. They have respect for other individuals. They like to celebrate other people's good fortune. They're happy when other people do well. I know we've all seen people who aren't like this. So people with high integrity do celebrate others. They help to develop others. They help to make other people good people. They don't put up with unjust acts. They stand up for what is right. So if somebody does something wrong, they'll approach them. They're forgiving and they really extend themselves to other people. So one of the issues in ethics that can be good and bad is that ethical managers really get to help to make their own rules. So managers, as business people or people in the work world, have the ability to establish our own rules to what we find acceptable and unacceptable behaviors. I love this example from Goldman Sachs that was in your book, but Greg Smith kind of called out Goldman Sachs. So in March 2012, the ethical conduct at Goldman Sachs was in the spotlight when a senior broker for the company, Greg Smith, wrote a letter to the New York Times titled, "Why I'm Leaving Goldman Sachs." In this letter, Smith, who had worked for Goldman Sachs for 20 years, stated that the culture at Goldman Sachs was toxic and destructive. He described the culture in the past as based on teamwork, integrity, humility, and always doing the right things, right? All the things we just heard about in the last slide. But now the client was second to the interests of Goldman Sachs. He stated that the decline in the moral fiber of the company represents the most serious threat to the long-term survival of the company. So basically he's saying by not being moral, they are not going to be successful. In addition, he cited examples when the Goldman Sachs managing director called their clients Muppets, and he said the most common question asked by junior analysts is, how much money did we make off the client? So he just really felt like they had gone away from being a company that was looking out for the well-being of others to being a company who was looking out for the well-being of themselves. So is everyone unethical? I think that sometimes we all try our best to be ethical, but we have moments where we're unintentionally unethical. And there's some ways in which this happens. So we try to be ethical, yet obviously there are times when maybe we don't even realize we're not being. All right. So one of those is that when we have implicit bias or prejudice. And this occurs, and I think every one of us can I see this when there's a bias that occurs that we don't even realize we're being biased. And maybe it's because we've never had an experience that's similar to other people, or we just don't even realize that we prefer one type of person over another, or one personality over another, or whatever it might be. So there is this IAT test, and I'll provide a link to it. I can't remember what it stands for, but basically you can see if you have any implicit biases. And so one of them that I personally love is, um, are you biased towards young or old people? Do you favor young or old people? And when I take it, my results for myself are that I favor elderly people, and that doesn't really surprise me once I take it because I really like old people or people who are older. I think that we can learn so much from them. It doesn't mean I don't like younger people or that I don't value them. It's just that now I'm aware that I have an implicit or unconscious bias, and now I can put that in check. And basically all I can do is acknowledge it and try to eliminate it. But so we all have biases that we don't even realize we have. And, it's something we have to be aware of or try to be aware of. In-group favoritism occurs when the decision maker forms a bias towards individuals in the same group. And this can be anything. It could be people of our same gender. It could be people of our same ethnicity. It could be people who are of our same age range. It could be people who have the same hobbies. And we all do this. We all tend to um, gravitate towards those who are similar to us. Claiming credit for others' actions, I think you've probably all seen this in the workplace or somewhere in your life where somebody says, where somebody takes credit for something that maybe they weren't the only one who should be taking credit for it. And then conflicts of interest. This is when decision makers favor a solution in which they would personally benefit. And we see this in personal and our professional lives all the time, where we make decisions because not only is it an okay decision for the company, but it's the best one for me as well. And we have to really just acknowledge, like, hey, am I having a conflict of interest here? Am I taking credit for other people's actions? Do I have favoritism? Do I have bias? And the more we can evaluate and acknowledge those, the better off we'll be. All right, so what are some barriers to ethical organizations? Well, if we don't have good goals, and so this is when we have goals that are set in hopes of promoting a positive behavior, but might actually encourage a negative behavior. So your book is the example of billable hours. So maybe a company says your goal is to have 30 billable hours this week, and you end up, you know, falsely listing your billable hours or to meet that goal, or you end up working on something longer than you maybe should have because you want to meet your goal of your billable hours. Motivated blindness. This is when managers overlook unethical behavior because it's in the best interest of the managers to not be aware of the actions. So, well, I didn't see that, so I can't say anything. Kind of that don't ask, don't tell, kind of turning a blind eye. Indirect blindness refers to not applying the same level of ethical accountability when there's an outside party. That's what a third party means, when there's an outsider involved in the questionable actions. They're like, well, they're not part of our company, so I guess it's not my problem. No, it still is. The slippery slope is when we start with like one small unethical action and it just kind of snowballs and develops over time. And then overvaluing outcomes is that we're more likely to be okay with unethical behaviors if our final outcome is positive. So that is just a really short overview of chapter 2. You can read it, you can look at the slides I posted, and then I think it's kind of a fun activity posted for your assignment. I'll also post that IAT So you can go ahead